Wanted to do a stock market review, take a look at what happened over the week. We had some news. For me, one of the most important economic indicators came out this week. We also got some information out of the Federal Reserve Chairman. But this week we got personal incomes, personal expenditures, and of course the PCE deflator, which is the inflation number hidden in with personal consumption and personal income. The PCE deflator is what the Federal Reserve looks at. It came out. There wasn't a resounding cheerleading squad on the side saying this was awesome because the number didn't fall nearly as much as anticipated, but still it's moving in the right direction. Nonetheless, there are other things. Personal income starting to slow down. The number of people on payrolls is starting to decline. We see that in continuing claims. The unemployment insurance numbers that we get on a weekly basis, those individuals who are losing their jobs are staying unemployed. Given these factors, let's take a look at the stock market, specifically SPY stock. SPY stock, of course, is the S&P 500 ETF. Given this, even though the stock market has rallied, in this stock market review, I'm going to show you the numbers that I'm looking at to say you might want to start taking profit. This economy is beginning to slow down. Maybe not into recessionary mood, but things are slowing down. Valuations on companies are going to contract. Analysts are going to start dropping their expectations for future revenue and profits. Because of that, when we see these kinds of move upward with SPY stock, you might want to hit the sell button. Let's jump in. If you are just finding me for the first time, thanks so much for jumping in. Make sure to hit that like and follow button. This is a breakaway channel that I have, and it's growing quite rapidly. Thanks so much for all those who are following along. I am D.H. Taylor. I'm an economist. I apply economic indicators as to the bigger picture for the stock market. What we're looking at right now, here's the S&P 500 index, and way off to the left, you can see we hit about 4,100. We're about 4,600 on the S&P 500. Bond yields took a sharp U-turn. We still don't have 100% information as to why bond yields were skyrocketing as much as they were throughout October, which really kind of crashed the stock market. Nonetheless, they've reversed. There's some good news out there with bond yields. Bond yields are softening, mostly given what we just heard from the Federal Reserve. I think it was either Thursday or Friday. The Fed chairman basically said, it was Friday. The Fed chairman basically said, we think we're right there. Okay, great. From here, the market is taking that as, okay, we're right here. We still don't have 100% of the information as to whether or not they will need to move interest rates higher. My position, I put out the 2024 stock market analysis and projection. I did that about a week and a half ago. We're right here. We don't have enough information moving forward yet, but I believe that the economy is going to slow down somewhat, then do a U-turn and start moving forward again. In the meantime, valuations, that's what it's all about. You have a comparable number. The benchmark 10-year Treasury yield, right now about 4.25, 4.3. That's your benchmark. They call it the benchmark because it is a benchmark. And you ask the question, I've got this as an opportunity. Just for the record, this is what Warren Buffett does. If I can invest in something over the course of the next 10 years and get 4.25% return, guaranteed, U.S. federal government, would I want to necessarily get into another investment that could yield more with a reasonable amount of risk? So that's why we look at the 10-year yield and ask that question. Now, what will happen with the 10-year yield? It was at 5% just a couple weeks ago. Now it's down to 4.25%. Where do we go from here? That's the big question. When we move forward and take a look at the economic data that hit this week, here's personal incomes. This is year-over-year rate of growth. It compares the number this year to where we were last year. There's a percentage rate of growth. If that percentage rate of growth, the year-over-year change, is increasing at an increasing rate, so will expenditures. Our economy is 70% driven by consumers. If incomes are increasing, so will consumption on an increasing rate, or if it's decreasing, on a decreasing rate. Right now, if we take a look, we've seen a kind of a big spike there, but if you notice, things are kind of softening a little bit. Two things. Number one, people aren't getting raises like they used to not too long ago. Number two, people are losing their jobs. So the whole number of individuals is shrinking, and those that are on those payrolls, the rate of growth is not increasing. The same thing is happening with expenditures. Expenditures are starting to look kind of downward. If expenditures start declining rapidly, so will revenue for companies. Valuations. So on the one hand, maybe the 10-year yield will soften a little bit. But the rate of growth of revenue gains for companies is softening a little bit. So will the profits. Because of that, we go back to the 10-year yield. If you have a company that's yielding, say, 3.25, 3.5, 3.75% over the next 12 months, their forward earnings divided over today's current price is only like 3.5%. You're looking at a 4.25% 10-year yield. You're also looking at an economy that's probably going to contract a little bit. What could happen? A whole bunch of people could get out of stocks pretty quickly and jump into that 10-year yield because the risk to reward ratio is skewed in favor of the 10-year. What happens if you bought at 4.25% and all of a sudden the economy starts contracting rapidly? Valuations start dropping rapidly. Most likely, the scenario is the Federal Reserve has to lower interest rates. Because of that, you bought interest rates at 4.25%, maybe the 10 years printing 3.75%. Your bonds you just bought are really in the money. You'd be able to sell it at a pretty high profit. Your downside risk doesn't look like the Federal Reserve wants to raise interest rates. So we've seen the dip in the price of the 10-year bond. So your downside risk is minimal versus potentially buying into stocks. Stocks trading at 3.25, 3.5% forward yield, the earnings you would get owning that stock over the next 12 months. If their revenue declines, so does their profits, which means the price is skewed towards risk. So I'm not in love with stocks at these prices because of the alternative. Look at incomes. Look at expenditures. They're pointing down. This economy is slowing. Valuations will need to adjust. Here's a look at personal incomes and personal expenditures, kind of the dual of them. This chart really iterates that when personal incomes, the green line here, starts to drip downward, expenditures follow suit. A lot of people are focused on the PCE inflation deflator, and as you can see, it's moving lower. Great. Awesome. Two things. Number one, inflation isn't the only thing. Federal Reserve is also taking a look at M2 money supply. They need to contract that. How do you do that? You keep interest rates higher for longer. The 10-year stays at a premium for now versus stocks where we're seeing the economy start to contract somewhat. Here's the core inflation deflator. This did come down in, Thursday's report. It came down, not as much as everybody thought was going to happen. Stocks moved up a little bit, then kind of sold off. They weren't exactly thrilled or in love with this particular chart right here. Sure, it's going downward. But if you look all the way back to the beginning of this chart, 1991, all the way to 1997, that's 6 years of decline before the Federal Reserve was able to contain inflation in such a way that they could get close to their target. On a 6-month basis, the Fed said, we think there's restrictions enough that over the past 6 months, we've only seen an increase of 2.5%. I have no idea why the chairman said that. We don't look at the rate of growth over a 6-month period of time. We look at the year over year. So I think he was trying to sell something there. I still don't. Why do I care about the 6-month rate of growth? I don't. I want to know the 12-month. Given this chart, when you look backwards all the way to the left and you see what it took to get down close to that 2% target rate, it took some time. And granted, we're seeing some time, but it's still pretty high. All right, continuing claims. Higher continuing claims. More people. Initial claims still is not exactly soaring. People are filing at a modest level. Nothing, we're not staring recession in the face. We're still staring a potential contraction, but we don't know how much. Mind you, GDP just printed 5.2% last quarter. Anything is going to contract beyond 5.2%. Hopefully, we're not going over 5.2%, or the Federal Reserve would hammer us with inflation, interest rates. Nonetheless, initial claims moving modestly higher. Continuing claims, if you lose your job, you're staying unemployed. This trend is moving higher, but we're a long way away from any kind of number that is drastic. Here's the yield on the Treasury yield. And as you can see, we kind of moderated a little bit, shot up a little bit, then kind of came back downward. Stock market for the week. S&P 500 took the comments from Friday and kind of went forward. I iterate. If I can buy in on the U.S. Treasury yield at a much better rate than what I can get out of stocks, I'm not buying any rally. Effectively, looking at this chart, you'd be buying at the very top. For me, that wouldn't be the period to be buying. I'm looking at the overall big picture and saying we're going to see some kind of continued contraction in the economy. It may not be a recession, but it will be a contraction to modest levels. But valuations would need to shift with these individual stocks. Take a look at the next 4 quarters and ask the question, if you bought that stock today, given the 4-quarter yield in the future, added up, divided over the top, what's a better investment? The 10-year or that particular stock? When you look at that, like the savvy investors, the investment hedge funds and retirement funds, trust me, that's what they're looking at. And they pack a punch. So if they start exiting stocks because of valuations, or don't get in and buy more stocks, but instead push their money into bonds, stocks come down. Make sure to hit that like and follow button. As well, there's links down below to my website. We'll see you in the next video.